Hello everyone, good afternoon. My name is Dave Adams. Today we're going to be talking about the stock Yirendai. Yirendai provides a service for investors and borrowers to find each other quickly using mobile services. Their online marketplace connects these users, helping them to find the best rates for their loans and controlling ROI using proprietary risk assessment software. So on the screen here, I've just kind of set up once over straight from their quarterly review of what their business plan is, their website there in the middle, how it kind of operates, and then on the left you can see registered and served borrowers versus on the right where you can see the registered and served investors, both of which are going up on a quarterly basis, which ultimately is leading to more and more profit for Yirendai. As you can see on the bottom there, they have a six-step end-to-end process, which will get you all the way from application through servicing and collections. So all this together, hopefully by the end of this we can talk about why or why not this stock should be in your portfolio. So first let's look at the balance sheet. This is going to be from June 30th, 2016 through June 30th, 2017, one fiscal year. And you can see at the bottom there, total equity. Equity has risen by 107% year over year, which is absolutely excellent. And on the right you can see a stock chart which pretty much replicates that verbatim. So excellent stock over the last year, which doesn't really mean anything for next year, but it does give us a good history and a good reference for what they've been doing. So far so good. Looking at some of their ratios, their PE ratio, 11.9, absolutely excellent, especially compared to the software industry that they're in. Price to book, 5.8, a little bit lower than the average of the industry. And then return on equity, assets, and capital, absolutely great, all of which beating their peers. The only one maybe worrisome on this page is the earnings growth, and we'll jump into that a little bit later and maybe see if that's accurate and trustworthy, and if that should be a stop sign. So real quickly, an important quote. This comes from Yirendai Fang. Hopefully I'm saying that roughly correctly, but she is the Chief Executive Officer and GM of Yirendai, and she said of the second quarter results, "We are delighted to deliver yet another solid quarter. Loan origination continued the strong growth momentum, especially from online channels, driven by our relentless focus on technological innovation. This quarter, we also launched our credit scoring system, the Yirendai system. It aims at delivering more precise and accurate characterization of our borrowers' credit profile. We stay committed to strengthening our technological and risk management capabilities to further enhance our industry leadership. Meanwhile, we will also continue to execute our strategic expansion into online wealth management business to provide more comprehensive investment solutions for our platform investors, leveraging CreditEase's broad wealth management product portfolio." Whew, what a mouthful, huh? So what is she saying there? She's saying that they've developed a system that allows them to better identify the credit sector that a borrower should fall into, and thus best find the rate of charge, right? So the thing that scared me the absolute most about this company is something that I'm sharing on the screen now. If we look at just the risk rate that they've assigned in the past, and then we look at the facilitation of the loans that they're giving, over 50% of their business comes from the bottom of the barrel in terms of risk. And this is a super, super caution sign to me. By their own calculations, 50% of their money is going to the most risky people. Now granted, the average transaction of these are between 24 and 27% average transaction fee rates. So that's absolutely great profit. But the thing that really surprised me was you can see their expected charge-off rate was between 9 and 13%. But this year, well, I should say this last reported year, 2016, they had actually gotten their charge-off rate down to as low as 3.4% across the company and across the loans that they originated. That's really quite impressive if you want to be honest. If you're loaning money out to the riskiest of the risky people and then you're getting it back 96.6% of the time, plus it's 20 some odd percent interest. That's a recipe for growth, and that's absolutely great. So that's what she was talking about when she said they continue to expand on their ability to identify these borrowers. And obviously they're doing something right, or they're just rolling the dice correctly a whole lot of times in a row, because over the last year they've really done well with this. And you can see in 2015, their C-grade loans, 10% write-off, this year at 4%. Wow, absolutely huge differential there, and they're heading in the right direction. So what does that mean in terms of profit? Yirendai manages a 31.3% net profit margin. The industry median is just 13%. This has allowed them to focus on the expansion she referenced, as well as paying down every single debt they had on the books, as you can see on the chart above. Actually, as you can better see on the chart now. And this lack of debt, combined with the leverage of their larger parent company, Credities, which you referenced there at the end, allows them specific expansion growth potential. And this is important considering the Chinese middle class is growing. So these two things coupled together allows this company a unique opportunity to grow without any debt to pay along the way. A couple cool talking points if we were to continue this argument. Let's just talk about GDP. U.S. GDP, 55,800 per head as compared to 7,900 per head in China. So a huge differential there. But China's growth, they're growing, right? So as that GDP grows, a small number grows percentage-wise so much faster, right? So as they get even up to 8.2, 8.5, that additional money will allow for additional consumption and additional financing on that consumption, two things that they also do less than of us. So all of these things combined continue the argument towards Yirendai and towards financing in general in the Chinese market. When I look at simply Wall Street, they have the current share price of $41 absolutely eclipsed by the future cash flow value. Well over 50% differential here. And this just shows us that, once again, there's a lot of upward mobility for this company. There's a lot of cash coming in and not a lot of cash going out. So if they continue on this path and can continue to avoid fraud and negative implications that come with high-risk loans, they'll absolutely continue to crush here. So what exactly is the catch, right? I've been so positive talking about this. Despite excellent mitigation of risk so far, it's likely Yirendai will see an upswing in charge-offs, considering their focus on subprime loans, right? Seems obvious. While these loans are excellent for margin and growth, a hiccup in the economy could really affect this company quickly and harshly. And suddenly you'll see a lot of those loans that are being paid not being paid, and that'll evaporate the pond quickly. And remember that earnings growth ratio we looked at compared to the price, it wasn't too pretty, and that indicated again that the growth that we've been seeing is maybe due to slow down in the near future, or at least maybe that the price is inflated versus what they're expecting. So that's a bit of a yield sign. And lastly, the company lacks dividend history. Though for what it's worth, the CFO did make a statement about this in the last quarterly release, which I'll go ahead and reference now. This was Dennis Kong, Chief Financial Officer for Yirendai, and he said Yirendai's revenue has continued to show strong year-over-year growth, which we've seen. The risk performance of our loan portfolio has remained stable due to our efforts in enhancing our credit underwriting and risk management system. We will continue to invest in our technology development and AI capability to drive our operational efficiency and risk management abilities. We will also continue to work closely with regulators to ensure our full compliance status with online lending industry interim measures. In addition, given our strong cash position and positive cash flow generation ability, our board has approved a special cash dividend and a semi-annual dividend policy going forward. So that's absolutely wonderful news, and it'll ultimately be the thing that fills out our snowflake here and really gives us just a lot of positives to look at here. So that semi-annual dividend will be 1.32%, and it's actually going to start on 9/28, just 18 days from today. So this payout is considerably higher than the average payout of software companies, which is another call out here. Maybe a little worrisome if they can maintain it, but this only represents 9%, so their payout ratio is super low. They can maintain it for the near future at least, so feel good about that. So let's recap here and wrap this up. Yirendai has an excellent PE ratio of 11.9. They're up 107% year over year in total equity. We saw that on the balance sheet earlier. The current price to book ratio, 5.8%, was lower than the industry average. Net margin, 31.3%, put Yirendai near the top of the industry and double the industry median. The growing Chinese middle class allows them to continue doing what they've been doing without having to search or battle for additional market share. And the introduction of that semi-annual dividend will now fill out our snowflake even more, making this an excellent long-term potential investment for those that can stomach potential volatility. Thank you so much for your time. I hope that you invest wisely, and remember, these are just my opinions. If you do have any questions, head down to the comment section below. I'm such a new presenter that nobody knows I'm here. So if you find me and you have a question, you better believe that I'm going to be here to answer it. Thank you so much for your time. I hope you have a great day.